Take a step back and look at the picture the way officials in Washington were reportedly forced to look at it. Fuel prices were climbing faster than the White House could publicly reassure the market. The Strait of Hormuz remained effectively blocked. Tensions between the United States and Iran were moving closer to open confrontation, and one of the most important pillars of coordinated oil supply management appeared to be cracking. That is the setting in which Donald Trump, according to multiple reports referenced in the transcript, convened an emergency meeting at the White House. On the surface, the official explanation was simple enough. The administration said the purpose was to review the energy supply chain and discuss market stability as consumers faced rapidly rising prices. But in the hallways, according to the version described in the broadcast, the meeting was understood very differently, not as a routine energy consultation, but as a firebreak plan aimed at containing a crisis in oil, confidence, and ultimately the wider dollar-based energy order. That distinction matters because this was not merely about what drivers were paying at the pump that morning. It was also about whether the United States still had enough leverage to shape the global oil market under wartime conditions, and whether the financial architecture that had long supported that influence was beginning to weaken. In that reading, the emergency meeting was not just a reaction to expensive gasoline. It was a reaction to a strategic loss of control. According to the account in the transcript, the meeting took place on Tuesday, April 21st, 2026, in the Roosevelt Room. Around the table were chief executives from some of the most powerful oil companies in the United States, including Chevron Chief Executive Mike Wirth and ExxonMobil Chief Executive Darren Woods, along with senior officials from the Departments of Energy, Defense, and Commerce. So that combination alone tells you the administration did not see this as a narrow commercial issue. When oil executives, defense officials, and economic policy makers are pulled into the same room on short notice, the problem is no longer just supply. It becomes strategic because oil prices affect inflation, military readiness, shipping, insurance, industrial input costs, and political legitimacy all at once. In other words, this is not only an energy story, it is a consumer story, a currency story, and a power story. Now, stay with the timeline, because this is where the pressure appears to have built quickly. According to the transcript, an Iranian drone attack against an Israeli-linked tanker in the Gulf of Oman was reported on April 14th. 2 days later, on April 16th, the United States Navy reportedly intercepted 3 Iranian fast boats attempting to board a vessel flying the flag of the Marshall Islands. Then came the market reaction. By Sunday, April 19th, Brent crude had risen by $12 in a single trading session, according to the narration, while gasoline prices in California climbed above $6 per gallon. In New York, natural gas futures reportedly reached levels not seen in recent periods, reinforcing the sense that this was broad energy stress rather than a localized oil spike. And over all of this sat the single most important choke point in the story, the Strait of Hormuz. The transcript states that since April 15th, the strait had remained blocked amid the mounting standoff between the United States and Iran. Whether one describes that situation as a total blockade, a severe disruption, or a practical closure, the implication is the same. A narrow waterway through which roughly 1/5 of the world's oil supply normally passes had become unstable. That is not a symbolic problem. That is a structural problem. When Hormuz is tense, the consequences do not remain in the Persian Gulf. They travel through shipping rates, refinery margins, futures contracts, insurance premiums, and eventually household budgets from California to Indiana, from Vancouver to Guadalajara. The administration, according to the transcript, issued a communication on April 21st suggesting the situation would stabilize by the end of the month. But by Thursday, April 30th, the speaker argued that nothing had stabilized at all. On the contrary, the sense in the broadcast was that the market had moved further away from control and that what had been framed as a short disruption was beginning to look like the opening phase of a deeper realignment. And that is where the second layer of the story emerges. The transcript does not present the White House meeting as merely a response to war risk. It presents it as a response to a political and financial shock triggered by the apparent fracture of what the speaker calls the Oil Cartel League, meaning OPEC+, and in particular by the decision of the United Arab Emirates to pull away from joint price regulation. If that reading is correct, then what shook Washington was not just rising oil prices, it was the possibility that the system used to coordinate production, influence pricing, and support dollar-denominated energy trade was becoming less reliable precisely at the moment the United States needed it most. That is why the meeting is portrayed not only as an energy conference, but as an emergency discussion about the future of the petrodollar. Let me be careful here. The transcript speaks in dramatic terms, saying the petrodollar had effectively ceased to exist as the world reserve arrangement, and that what remained was now unraveling. A more neutral formulation would be this: the events described were being interpreted by some analysts and commentators as an early sign that parts of the global oil trade could begin shifting into alternative currencies, especially if major producers concluded that Washington was no longer a stabilizer but a source of disruption. That concern is not abstract. For decades, the strategic weight of the United States in the energy system did not rest only on production, military reach, or alliances. It also rested on the fact that a large share of global oil transactions were tied to the dollar, reinforcing demand for dollar liquidity and giving Washington an enormous financial advantage. If producers begin selling more crude outside that framework, the impact may unfold slowly, but it can still be profound. The transcript frames the American strategy as self-defeating. It argues that Washington weakened Russian energy supply chains to Europe, then moved in practice toward disrupting Persian Gulf energy flows as well, all while expanding the position of the United States as a major exporter. Since January of 2024, according to the speaker, the United States had become the world's largest crude exporter, surpassing traditional giants such as Saudi Arabia and Russia. That claim, whether one interprets it narrowly or broadly, is central to the analysis. The suggestion is that the United States profited strategically from earlier energy disruptions, especially after Europe reduced dependence on Russian supply, but then pushed the system to a point where key Gulf partners began to view American policy not as protection, but as manipulation. In that interpretation, Saudi Arabia and the United Arab Emirates were not simply allies navigating a crisis. They were actors reassessing whether they had been used. And the argument becomes sharper when the transcript turns to the United Arab Emirates. According to the narration, Abu Dhabi read the evolving situation as a betrayal and responded by stepping away from the collective price regulation mechanism. If a major producer decides that coordination under the old framework no longer serves its interests and then begins exploring sales in currencies other than the dollar, that is where a market crisis starts to become a monetary one, and that does not mean the dollar disappears overnight. It means confidence begins to erode at the margins, and global systems are often changed first at the margins. A producer experiments with non-dollar settlements here, a bilateral energy agreement is rewritten there, central banks diversify reserves a little faster, and what initially looks like noise slowly becomes a pattern. Now, here is the contradiction at the center of the White House emergency meeting, and it is one of the most revealing parts of the transcript. While consumers were facing pain and officials were talking publicly about stabilization, the largest American oil companies were not necessarily losing from this crisis. In fact, according to the figures cited from the Energy Information Administration, for the first quarter of 2026, Chevron's profits had risen by 34% compared with the previous quarter. The transcript goes further, arguing that when oil reaches around $95 per barrel, some American producers can generate margins of roughly $45 per barrel. Whether one accepts that exact figure or treats it as a rough estimate, the underlying point is clear enough. In a high-price environment driven by geopolitical disruption, major producers can earn extraordinary returns, even as households and governments absorb the political damage. That is what the speaker describes as undeclared war profit. This is not a conspiracy theory in the way that term is often used. It is a structural feature of the energy market. When supply is constrained, risk rises, and prices jump, the pain is distributed unevenly. Consumers pay more immediately, governments lose room to maneuver, and large producers with existing output capacity can benefit quickly. That is why the emergency meeting may have contained tension even among people whose broader interests aligned. And the White House needed lower prices, or at least the appearance that it was trying to lower them. The oil companies, by contrast, had little commercial incentive to rush toward anything that would significantly compress margins unless the political pressure became impossible to ignore. And yet, according to the transcript, one of the options that was not meaningfully on the table was the most obvious one to many viewers, a major new release from the Strategic Petroleum Reserve. The Energy Secretary reportedly confirmed that reserve levels were at their lowest point since 1983. That detail matters because it helps explain why Washington's room for maneuver may have been much smaller than its public messaging suggested. Why not simply refill the reserve or deploy it more aggressively? The answer offered in the broadcast is brutally simple. Buying back large volumes of crude to rebuild reserves would itself push prices higher, while releasing too much from an already depleted reserve would advertise weakness rather than restore confidence. So the administration, in the transcript's telling, was left leaning toward a passive market approach. Let prices adjust, let producers maximize available supply, and hope the system stabilizes on its own. But there is a flaw in that logic, and it is the flaw the speaker emphasizes. Markets cannot magically correct an actual physical shortage if the bottleneck is geopolitical and maritime rather than merely financial. If the Strait of Hormuz remains under pressure, if Iranian deterrence continues to shape shipping behavior, and if OPEC Plus coordination weakens at the same time, there is no quick self-healing mechanism. Tankers do not move because officials prefer calm headlines. Refiners do not secure feedstock because press offices promise normalization by month's end. Here is what makes the story larger than a temporary war scare. The transcript suggests the United States can no longer coerce Iran into backing down through sanctions alone, and that threats of bombing have not produced the desired strategic effect. At the same time, the largest American energy firms are enjoying strong wartime pricing, which creates a divergence between national political needs and private corporate incentives. That divergence is not new in history, but in this case it appears to be colliding with the architecture of global trade. If Washington cannot guarantee flow through the Gulf, cannot fully discipline Tehran, cannot easily lower domestic fuel costs, and cannot rely on full producer coordination from Gulf monarchies, then every pillar of the old energy order begins to look less solid. That is the real alarm behind the emergency meeting. The liquefied natural gas question, raised in the transcript, adds another important layer. According to the speaker, executives and officials discussed export permits and licenses for how much liquefied natural gas the United States could send to Europe under the justification of replacing disrupted Iranian-linked supply exposure. That tells you the administration was not just managing a current crisis, it was also trying to exploit a market opening. But here again, the logic cuts two ways. In the short term, more American liquefied natural gas and crude exports can strengthen U.S. commercial influence and partially offset shortages elsewhere. In the longer term, however, If allies and producers conclude that Washington benefits repeatedly from instability in rival supply corridors, trust erodes and countries begin looking for hedges against overdependence. That appears to be the strategic lesson the transcript says Saudi Arabia finally read, albeit late. The argument is that Riyadh watched the United States benefit first from the rupture of Russian energy links with Europe, and then from turbulence in the Gulf itself. In that framing, American power did not protect the old order. It monetized the breakdown of the old order. Whether one agrees with that assessment or not, the political consequences are easy to understand. No producer wants to feel that its partnership is being leveraged in ways that make it more replaceable. No exporter wants to discover that its own supply role has been weakened while another actor steps in to sell the substitute. That is why the departure of the United Arab Emirates from coordinated regulation, if confirmed in the way the transcript presents it, would be so consequential. It would not simply mean one member leaving a pricing coalition. It would signal that discipline inside the producer bloc is fraying at the exact moment global markets most need coordinated signaling. And once discipline frays, narratives move quickly. Traders begin asking whether more members could drift. Consumers begin wondering how long price spikes will last. Central banks and sovereign buyers begin calculating whether future contracts should be settled in a wider basket of currencies. This is how geopolitical shocks ripple outward, first as headlines, then as hedging behavior, then as structural change. The real-world impact is already visible in the examples referenced during the broadcast. A viewer from Indiana reportedly said gasoline had reached $4.99 per gallon that morning. Other states, according to the speaker, were seeing prices as high as $8 per gallon, while some markets remained lower, around $3.50, illustrating how unevenly the shock was moving through the country. Even the lower number, in the context provided by the speaker, was treated as extraordinary compared with pre-crisis conditions. The point was not that every state faced the same price. The point was that the direction was unmistakable. The pace was politically dangerous, and the burden was already becoming visible in ordinary household budgets. This is why stories like this cannot be dismissed as distant geopolitical theater. When a maritime choke point tightens, the first signs may appear on tanker tracking maps and commodity screens, but the consequences arrive in a far more intimate place. They arrive at the gas station, in grocery distribution costs, in heating bills, in freight surcharges, and eventually in public anger. The transcript also makes an important regional point that often gets lost in US-centric coverage. Mexico has major oil income, but it also imports gasoline, which means it can benefit from high crude in one channel while suffering through expensive refined products in another. Canada is a producer too, but refining constraints mean it is not insulated from international disruptions either. And that is why the speaker mentions places as varied as Vancouver, Guadalajara, and Colombia. When Hormuz tightens, the shock is global even when local price dynamics differ. Some governments gain revenue, some companies gain margin, some traders gain volatility. But consumers almost everywhere end up paying more. Now consider the political optics inside the White House. A government facing a fuel price surge has only a few tools available in the immediate term. Release reserves, pressure producers, adjust export policy, impose temporary regulatory relief, signal military deterrence, or try to cool expectations through messaging. According to the transcript, none of those options looked particularly clean, and several carried heavy costs. Releasing reserves is constrained by the low level of stocks. Pressuring producers is difficult when those producers are politically connected and commercially thriving. Restricting exports can antagonize allies and markets. Military escalation against Iran risks turning a price shock into a full supply catastrophe. And messaging alone stops working once people see the numbers on fuel station signs. That is why the emergency meeting is best understood as a symptom rather than a solution. It revealed that the administration recognized the scale of the danger. It did not, at least in the version presented here, demonstrate that Washington had found a workable path out. There are also two forward-looking scenarios embedded in the transcript, and they deserve close attention. The first is domestic. If the Trump administration authorizes Chevron and Exxon to reopen wells in the Gulf of Mexico that had been closed since 2021, that would be a strong signal that officials expect the crisis to last. Not days, but much longer. Reopening dormant capacity is not something governments push for if they believe calm is around the corner. The second scenario is external and far more dangerous. If Iran decides to escalate beyond maritime harassment and proxy pressure toward direct attacks on Saudi energy installations, the conflict would move on to an entirely different level. According to the speaker, Tehran had so far been careful not to cross that line, but each intercepted drone and each blocked move narrows the space for restraint. That warning is not melodrama. It is an acknowledgement of escalation logic. In high-pressure confrontations, actors often avoid the most damaging target until they conclude that limited signaling no longer produces leverage, at which point the threshold can be crossed quickly. The transcript also points to another pressure point, patience inside OPEC Plus itself. If one member has already walked away from coordinated discipline, others may begin to reassess the costs of staying aligned under stress. The longer the market remains dislocated, the harder it becomes to maintain a united front, especially when members face different fiscal needs, strategic alliances, and views of Washington. And this is where the petrodollar theme returns, not as a slogan, but as a strategic mechanism. If more producers choose flexibility over block discipline and begin accepting payment in a wider set of currencies, the United States loses more than prestige. It loses part of the automatic global demand that has long supported the dollar's privileged role in energy and finance. Again, that process would not be instantaneous. Reserve systems do not vanish in a week, and the dollar retains enormous institutional advantages. But the transcript's warning is that the world does not need a dramatic collapse to change. It only needs enough major actors to decide that diversification is safer than dependence. So what then was the White House really trying to do in that room? Based on the account we have, the administration was trying to buy time. Time for markets to calm, time for producers to cooperate, time for domestic political backlash to soften, and time for Washington to prevent an oil shock from becoming a currency signal. But buying time is not the same as solving the underlying problem. So if the core issue is that supply routes are insecure, producer trust is eroding, reserves are thin, and corporate incentives are misaligned with consumer pain, then time can just as easily deepen the problem as resolve it. That is the hidden risk in relying on market self-correction during a strategic blockade. There is also a broader lesson here about power in the energy era after easy assumptions have died. Being the world's largest exporter does not automatically mean you control the market. Having the world's strongest military does not automatically mean you can reopen every choke point at acceptable cost. And issuing sanctions does not automatically mean your adversary will fold. That is not a commentary on American industrial strength. It is a commentary on how geography, shipping, alliance, politics, and financial confidence intersect in the real world. The closer a crisis gets to a maritime choke point and a currency arrangement at the same time, the less room there is for symbolic gestures. Which brings us back to the apparent panic behind the meeting itself. According to the transcript, this was not the posture of an administration calmly managing a fluctuation. It was the posture of a government realizing that every lever it usually relies on had become more expensive, less effective, or both. Oil prices were rising, consumer confidence was vulnerable, reserves were low, corporate producers were profitable enough to resist urgent pressure, Iran had not been neutralized. Gulf unity was weakening, and the possibility of non-dollar oil transactions was becoming harder to dismiss as fringe speculation. So that is why this story may matter far beyond the next few trading sessions. If prices ease, some will say the panic was overstated. But if the underlying relationships continue to shift beneath the surface, then what looked like a temporary emergency meeting may later be remembered as one of those moments when you're told system first showed its fractures in public. Watch the next moves carefully. Watch whether dormant Gulf of Mexico production is reactivated. Watch whether more producer states challenge collective pricing discipline. Watch whether shipping through Hormuz normalizes or remains constrained. And watch, above all, whether energy trade begins to migrate, even modestly, into currencies beyond the dollar, because that is the unasked question sitting underneath every gasoline price spike and every official reassurance. Is this just another oil shock, or are we watching the first visible phase of a larger transition in how energy, power, and money are organized? The emergency meeting suggests that even inside Washington, that question can no longer be ignored. And somewhere behind the daily headlines, behind the corporate earnings calls, behind the promises that markets will stabilize soon, the deeper mechanism remains in motion. Choke point stays under pressure, producer trust keeps thinning, consumers keep paying more, and governments discover that the system they thought they could manage is no longer responding on command. That is why this is not merely a White House story. It is a story about whether the architecture of energy order is beginning to bend in plain sight.